Hey there, I'm Jason Barber with Holistic Planning, and today I'd like to visit with you about actively managed investments and actively managed mutual funds in particular. Many clients that come to us that move their money to us from other broker-dealers typically show up and they've got a wide portfolio. They've got 20 mutual funds in their portfolio, and most oftentimes these are actively managed mutual funds. Things like American Funds, MFS, T. Rowe Price, so on and so forth, right? And not picking on any particular fund as one being better than the other, but just more so using those names as examples. Now, oftentimes, one of the conversations that we have just kind of philosophically is this idea of, should I be investing in actively managed mutual funds versus just investing in a passively managed index fund or a lower cost ETF, something that maybe is just trying to mirror an index. And by an index, I would mean maybe just like an S&P 500 stock market type index, for example. And this is not likely something that we would be recommending a person have all of their money in, but just for whatever part of their money that they want to be invested in publicly traded equities, for example. And what I always like to highlight for people is to help folks to understand that there's a few different things to consider here, right? An actively managed investment, in essence, basically means that you are paying a fee to a mutual fund manager to buy and sell stocks, securities, bonds, whatever it may be that they're selling, with the idea being that they are hoping that they're going to outperform either in a just straight line return performance basis or based on maybe a risk-adjusted return basis, but they're hoping that they're going to outperform the index over some period of time. And that's why you're paying a fee to the mutual fund company to do that. I would say that most clients, again, that are coming to us, when we analyze the underlying investments that are in their portfolios, I would say that the average expense that they are paying to a mutual fund can be somewhere in that 0.5% range. Again, that's not scientific number there, but that's just me giving you an estimate that I would say a typical client that we see is usually paying somewhere around that. I'm sure some of them are more expensive than that, and some are less expensive. But you compare that, for example, to say a S&P 500 index fund where the cost may be closer to say 0.05%. So most clients are probably paying about 0.5%, give or take a little bit more, if they're investing in actively managed mutual funds. So what I then point to, and we'll link to this video as well, is something called the SPIVA Report. And every year, and even in the middle of the year, these SPIVA reports get updated. And there's a tremendous amount of data that can be gleaned from these reports. But what I really like to highlight, and I apologize for looking down here, but I just want to make sure I read these numbers exactly right, is this is the mid-year 2024 SPIVA report. And if you look at all domestic funds and you compare their performance to the S&P Composite 1500, which is the comparison index that we're using here, and if you look at year to date, now this number that I'm reading off here is the percentage of funds that underperform the index. Okay, so restate that. The percentage of funds that underperform the index, that do worse, think of it as like, okay, percentage of time that I would have just been better off to have just bought the index. Okay, so year to date, 76.56% underperformed the index. 1 year, 76.17%. 3 years, if you give it 3 years, 90.09% of the funds underperformed. If you give it 5 years, it's 85.91% of the time. 10 years, 90.08. 15 years, 93.42. 20 years, 94.31. And they really go into greater detail where you can even analyze, okay, well, just show me all the large caps or all the mid caps or all the small caps or large value, et cetera. So ultimately, that's one way that we really try to add value to clients, is to help them to kind of understand what this means and understand what the data tells us, and just use this empirical evidence to say, hey, for whatever part of my money that I want to be invested in a diversified portfolio of publicly traded equities, okay, it is our opinion, my opinion, that a client is most likely better off lowering their fees, right? Lowering their fees and owning a passively managed equity index that maybe is for example, like an S&P 500 fund, or a NASDAQ fund, or a mid cap or small cap, et cetera. And so ultimately, that's something that I would encourage you, that if you're looking at your investment portfolio, and number one, if you don't really understand what you own, that's a problem, right? But number two, ask us, give us a call, for a free review, and we'll look at that and help you to better understand, hey, are you just put into a portfolio of actively managed mutual funds that are underperforming the index, or at least statistically likely to underperform the index, given some period of time? And if you are, then I think you deserve a second opinion over what we can look at doing better for you to lower your fees and deliver more value to you. So if that resonates with you, please reach out to us. Go visit holisticplanning.com, and we'll be sure to schedule an appointment with you and review what your holdings and give you a second opinion complimentary, and help you to do the best for you and your family. Thanks so much for paying attention to the video and staying tuned, and I look forward to hearing from you soon.